In 2008, 8 million Americans lost their homes to foreclosure. But here's the part nobody talks about. Most of those losses were completely preventable. Hi, I'm Jonathan Reed. Over the past 20+ years, I've built a portfolio of 30+ rental properties across multiple states with millions in assets under management. And I've made almost every major real estate mistake you can think of and learned from them. When the 2008 crisis hit, I watched investors lose everything. Not because the market turned, the market always turns, but because they made 5 specific predictable mistakes that amplified that downturn into catastrophe. And here's what really gets me. I'm watching investors make those exact same mistakes right now in 2024 and 2025. So today, I'm walking you through the top 5 real estate investing mistakes from the 2008 crisis. The real lessons with actual numbers, so you don't have to learn this the expensive way. Let's start with the biggest one. Mistake #1. Overleveraging without a buffer. This was the killer in 2008. I remember in 2006 and 2007, I worked with investors who were buying properties with 95%, sometimes 100% loan-to-value financing, zero down, negative cash flow, betting everything on appreciation. Here's the math that killed them. A property purchased for $300,000 with 95% LTV financing means you put down $15,000 and borrowed $285,000. When that property dropped 15–20% in value, which happened to median home prices across most major markets, suddenly you're underwater. In Nevada, median home prices fell from $335,000 in 2007 to $117,000 by 2012. That's a 65% decline. Now you owe $285,000 on a property worth $255,000. But here's the real problem. You had no cash buffer, no reserves, no breathing room. In my experience, this is still happening. Last year, I reviewed a client's portfolio who'd purchased 4 properties using 90% plus LTV financing on adjustable rate mortgages. They looked great on a spreadsheet when rates were 3%, but when the Fed raised rates through 2023–2024, suddenly those monthly payments increased by $800, $200 per property. One down month of vacancy and they were liquidating assets. Here's what I do instead. I never go above 75% LTV on a rental property. That 25% equity buffer is my shock absorber. Why? Because if the property value drops 20%, I'm still okay. If vacancy hits harder than expected, I can float it. If cap rates compress and I need to hold longer than planned, I'm not desperate. The math is simple. $300,000 property at 75% LTV means $225,000 loan and $75,000 down. That feels like leaving money on the table when you're buying, but it's actually how you survive downturns. Mistake #2. Ignoring cap rate reality. Buying on hope. This mistake is especially dangerous because it sounds sophisticated. Investors would buy properties with terrible cap rates, arguing, but appreciation will make up for it. A cap rate is your cash-on-cash return in year 1. It's simple. Net operating income divided by purchase price equals cap rate. Let me give you a real example. In 2006, I saw investors buying residential properties in hot markets with 2–3% cap rates. They justify it by saying, real estate always appreciates. Then 2008 hit. Prices didn't appreciate, they crashed. And suddenly that 2% cap rate was actually a -15% cap rate because property values collapsed. Per my analysis of 2024–2025 market data, residential properties in strong markets are trading at 4–6% cap rates. Commercial properties are higher, 6–10%. These aren't arbitrary numbers. They reflect the actual cash flow the property generates relative to what you paid. Here's what I've learned. If a property's cap rate doesn't make sense as a standalone investment, meaning it doesn't cash flow reasonably in year 1, it's a speculation play, not an investment. And speculation is how fortunes disappear. I rejected a deal last month. Beautiful house, great location, but the numbers said 8% cap rate. The seller expected it. I didn't buy it. Why? Because if I'm wrong about appreciation, if the market stays flat or declines, I'm holding a negative cash flow asset. That's not investing, that's gambling. The investors who survived 2008 were the ones who bought properties that made sense on cash flow alone. They didn't need appreciation. Appreciation was a bonus. Mistake #3. Skipping due diligence on fundamentals. In 2006–2007, I saw investors buying properties without inspections, without understanding the local market, without analyzing tenant quality. They were buying blind because prices were moving so fast. I had a colleague who bought 12 properties in Phoenix between 2005–2007 without doing detailed inspections on a single one. When the market turned and he had to actively manage these properties, he discovered major issues: roof problems, foundation cracks, HVAC systems that were 20+ years old and failing. The deferred maintenance alone cost him $40,000 plus per property to address. Now he couldn't rent them at market rates because they needed work. He couldn't sell them because the market had collapsed. He was trapped. Due diligence isn't just about the property condition. It's about understanding the market fundamentals where that property sits. When I evaluate a market today, I look at: is employment growing or contracting? What are median home prices doing year over year? What's the population trend? What's the rental demand? In 2024, median home prices vary wildly by region. In some metros, they're $285,000, $350,000. In others, $450,000, $600,000. These aren't interchangeable. A market where prices are rising 3–5% annually with strong employment growth is fundamentally different from a market where prices are flat and unemployment is ticking up. I spent 8 hours last month evaluating a market I'd never invested in. Looked at employment data, population trends, new construction rates, rental inventory, decided against it. Why? The fundamentals didn't support the price point. 2 years from now, I'll be glad I passed. Mistake #4, chasing appreciation instead of cash flow. This is the philosophical mistake that enables all the others. In 2006–2007, the narrative was, real estate always goes up. You make money on appreciation, not rent. Investors would buy properties that lost money every month, betting on 10–15% annual appreciation to save them. Then appreciation stopped, then it reversed, and those investors got wiped out. Here's what I believe based on 20+ years of actual experience: cash flow is real, appreciation is a bonus. If your entire strategy depends on appreciation, you're not an investor, you're a speculator with a mortgage. Let me give you the math on one of my properties. I bought it 10 years ago for $285,000, put down 25%, borrowed $213,750. The monthly rent is $1,950. After mortgage, taxes, insurance, maintenance, and HOA fees, in this case $280/month, I net about $620/month in cash flow. Over 10 years, that's $74,400 in cash flow profit, plus mortgage principal paydown of about $85,000. Total gain $159,400 before appreciation. Now that property has appreciated. It's worth roughly $385,000 today. That's $100,000 in equity gains from appreciation. But here's the thing: if it hadn't appreciated at all, if it was still worth $285,000, I'd still be happy, because I've been making money every single month. I don't depend on selling it or prices rising. I'm making money regardless. That's the difference between investing and speculating, and that's why I survived 2008. Investors who depended on appreciation got crushed. I was fine because my cash flow worked even when prices dropped. Mistake #5, no diversification across markets. In 2008, the investors who got hit hardest were often concentrated in one market. They had 5 properties, all in Phoenix, or all in Las Vegas, or all in South Florida. When those markets crashed 40–50%, they lost everything at once. I learned this lesson early. Today, I have properties across 7 different markets. Why? Because no market is immune to downturns, but they don't all turn down at the same time. When I analyze a new market, I'm asking, what's the demographic? What's driving job growth? What's the rent-to-price ratio? Is it a high appreciation market or a high cash flow market? I have some properties in markets where appreciation is slower but cash flow is strong. I have other properties in markets with higher appreciation potential but tighter cash flow. The balance matters. But I never have more than 4–5 properties in any single market. If that market struggles, I'm not wiped out. I have 25+ other properties generating cash flow. A lot of investors avoid this because managing properties in different states seems complicated. It's not. Property management companies handle the day-to-day. My job is to analyze deals, structure financing, and audit performance. The location doesn't really matter from my office. How to audit your portfolio today. Let me give you a framework to evaluate your own situation right now. First, calculate your loan-to-value on every property. If any property is above 80% LTV, that's a warning flag. If any property is above 85% LTV, that's a red flag. You need equity buffer. Second, calculate cap rates. For each property, take your annual net operating income and divide by the purchase price. If you're seeing sub 4% cap rates on residential property, you're dependent on appreciation. That's not necessarily bad, but you need to be conscious that it's a riskier position. Third, review your debt. How many properties have adjustable rate mortgages? If rates tick up another 2%, what happens to your cash flow? Can you still handle it? Fourth, look at geographic concentration. How many properties are in your largest market? If it's more than 30% of your portfolio, consider rebalancing. Fifth, audit your due diligence process. If you can't articulate the market fundamentals that support each property's price point, you haven't done enough homework. These 5 steps take maybe 2 hours. They could save you 6 figures or more if a downturn hits. The real lesson, the 2008 crisis didn't cause the mistakes, it exposed them. Investors made these 5 mistakes during the